Welcome to Module 2, Section 4, where we will try to answer in this section, what is a mutual fund? One of the things that investors really want to do is be diversified. That means don't put all of your eggs in one basket. You take your money and spread it out into many different areas so that if one area has some real problems, other areas might do a better job of staying up, if not advancing. Some investors also take this to the next level where they put some into the stock market, some into the bond market, some into precious metals, and they are diversified that way. Well, the idea behind a mutual fund is that you can diversify through many different instruments using the same money that you would to buy one investment instrument. So many investors desire to use the principle of diversification. Another way to state this is don't put all of your eggs in one basket. That's great when you're right, but it can really be detrimental if you are wrong. For example, if a stockholder owns one company and that company's stock increases in value, you've made money. That's really good. Let's say you have $1,000 and you decide to invest in Google. Well, if Google goes up after the time that you buy that stock, you are looking at a profit, whether it's a realized profit where you sold the stock or an unrealized profit where you hold on to the stock but you have not sold it yet. However, if that stock decreases in value from the time that you purchase it, the stockholder is losing money at that point. Some investors find owning individual stocks to be very rewarding. And some of you watching this course, you want to find different investments out there. You may hold on to them for a short period of time or a very long period of time, but you really get a kick out of doing that. Well, other investors, they see that as quite risky. They don't want to invest in individual companies. They want to spread things out. Only you can answer that question. And you may have a combination of the two. Your portfolio may have mutual funds, or it may have individual stocks or bonds or different types of investments at the same time. Another alternative to putting all your eggs in one basket is often sought. This is where mutual funds come into play. Risk can often be avoided, not eliminated. It's never eliminated, but it can be avoided by pooling money where your $1,000 is combined with thousands of other investors. They take that money and put it into a mutual fund. So then instead of dealing with a little bit of money, the mutual fund has a lot of money to buy lots of different investments. A mutual fund is managed by a professional money manager. And some of these people have become like rock stars. If they're really good at what they do, they become very well known. A mutual fund manager then takes that pool of money from many investors and then invests it on their behalf. So you have a professional money manager working for you if you invest in a mutual fund. There are many kinds of mutual funds. In fact, there's probably more mutual funds out there than there are stocks. People will get together and say, well, I want to create a mutual fund. And they come up with some formula for what they think will give them an edge over other mutual funds. And when you have a large number of people doing this, you can actually have more mutual funds than there are stocks. Some combine stocks and bonds together. It may be 80% stocks and 20% bonds. And then if we switch to an environment where the stock market starts to go down and bonds are holding up quite well, the manager may switch over and be more heavily weighted in bonds. If you decide that you want to invest in a mutual fund, you're going to get something called a prospectus. These are basically the laws of the mutual fund. Every mutual fund is required by law to publish a prospectus. And a lot of times you can go to the company website and just download a PDF, or different brokerage outfits like Charles Schwab, TD Ameritrade. They may have a prospectus available that you can download, and these are free. You don't have to pay for them, where you can just read about the mutual fund and find out what kind of investing they do. A mutual fund cannot invest outside of the parameters that are stated in that particular prospectus. So if you have a mutual fund that says we're only going to invest in S&P 500 companies, they can't go out and invest in Japanese companies or European companies. The US companies may do business in other countries, but they have to be based in the US. Or you may get into a mutual fund that deals just with computers. Well, they can't go out and buy biotech stocks or pharmaceutical stocks. An investor must read and understand the prospectus before investing in that mutual fund. You sign a piece of paper saying that you understand what's in this, even if you haven't read it. And if you don't sign that, you won't be able to invest in that mutual fund. It's a way that they can use to protect themselves. Well, they give you a prospectus telling you about the mutual fund, and that is supposed to protect you, so that you understand what you're getting yourself into. The prospectus used to have a lot of legalese and really hard to understand information. This has been changed because a lot of people were saying, yeah, I signed the dotted line, but I didn't really understand what I was reading. And the prospectus would be manipulated into a way that protected the mutual fund, but it didn't protect the investors. There were changes that have been enacted to make them a lot easier to understand, and so that you have a better clue of what you are investing in. And there are lots of different types of mutual funds. There's virtually a mutual fund available for any type of investing that you might want to do. If you want to focus on West Coast stocks, if you want to invest in Asian stocks, or if you're interested in energy, high tech, or automobile stocks, or entertainment stocks, there's a mutual fund out there to meet your need. Now, why would people want to do this? Number one, they might think it's a good investment. Secondly, you might work in this area. This might be something that you know a lot about. And so you like to invest in things that you understand. You know a lot about a particular industry group or particular sector. And so you decide that you want to invest in what you already know about. Mutual funds can invest in indexes. Some of the most popular mutual funds are index funds. You can get a mutual fund that's based on the S&P 500, and that's what I teach. You can also get mutual funds that are based on the Dow or the NASDAQ 100 or small cap stocks, mid cap stocks. There's a lot of different indexes out there that you can base a mutual fund on. And personally, I see a lot of advantages to doing it that way, and I'll explain that as I go through this course. There are different sector mutual funds. As I stated in a previous video, the S&P 500 is broken down into 11 sectors. You may find times where one sector performs better than another sector, and so you get into that mutual fund. And when you see that mutual fund starting to have trouble, you might switch over to a different mutual fund. You might be interested in different regions, as I mentioned, West Coast, or maybe in the East, or maybe all of Asia, or maybe in European stocks or South American stocks. You have those opportunities available to you. Or different countries. There is just a China mutual fund. There is a German mutual fund. And different types of stocks. As I talked about in the previous section, there are different classes of stocks. Some of these stocks might be Class A, B, or C shares, while some stocks may be more growth-oriented, where other stocks are considered to be more value-oriented, and you might want to focus on one of those particular areas. Some mutual funds only invest in bonds. In the previous section on bonds, some of you might find that kind of confusing and you don't really understand it. You might find it easier to get into a bond mutual fund. And then, as I said before, some have a mixture of both stocks and bonds together. New mutual funds are being created and other mutual funds go defunct each day. Some get bought out by other companies and they merge into one mutual fund. Some mutual funds don't do a very good job of managing their money and they end up going out of business. Somebody has the latest and greatest idea, and so they come out with a new mutual fund. According to a website called Statista, at the end of 2019, which is the most up-to-date information I could find, there were over 7,945 mutual funds that had a worth of approximately 21.29 trillion. So they are very, very popular. And this has been what most investors have used throughout history. They really started to come about in the 1930s and 40s and into the 50s. And it gives average everyday investors a chance to participate where you don't need to know all the information that a professional stock operator would have to know. If you have a 401k, they're probably using mutual funds within your retirement account. If you have a Roth IRA, you're probably using mutual funds. So here's a chart that I found at Statista that just shows the number of mutual funds up through 2019. And it's declined a little bit because of the section coming right after this where I talk about ETFs. Those are becoming very, very popular. So we're seeing the number of mutual funds start to go down as the number of ETFs start to go up. So what are some of the benefits of getting into mutual funds? They do have many different benefits. This can include long-term investors who have found that mutual funds can be very good for creating wealth. If you get into a mutual fund, especially an index fund, and let's say every month you put in $100 or $50 or $1,000, and then you let that grow over a period of time, when it gets to the point where you're looking to retire, you may have built up a really nice nest egg. One of the books that I would recommend, and I'll go through this at the very last section in this course, is a book about mutual fund investing. It's very worthwhile to consider having some books in your library, especially on mutual funds. Some of you love mutual funds and you've been using them for a long time, but you may not really understand a lot about them. There are a lot of excellent websites, Morningstar.com, Yahoo Finance, different services out there that will help you try to figure out what mutual funds are best for you. And there's a lot of YouTube videos out there in addition to what I have that you may find very useful. The book that I would recommend is called The Little Book of Common Sense Investing, and it's written by John Bogle. And I'll talk more about him here as I go through this particular section. But he basically is credited with starting a thing called index investing. I do have a video where I review and go through the high points of this book in that video. It's not part of this course, but it is available on my YouTube channel. What are some of the additional advantages of mutual funds? Dividends and interest can be reinvested. I've talked about stocks that pay dividends, which are part of the profits that you can receive. I've talked about interest that is paid from bonds. Well, instead of taking that as income, what a lot of investors decide to do is just reinvest that. So you might be socking away your $100 a month, but anytime there are dividends or interest, that also gets reinvested as well. Dividends and interest can be reinvested. Mutual funds also offer a real convenience. They're common and pretty easy to buy. You can go down to your bank and get into mutual funds. For years, I was in State Farm mutual funds, and I had my auto insurance through them. Companies like Safeco, Charles Schwab, Fidelity, a lot of these really big companies that are household names offer mutual funds. They typically have low minimum investments, and if you just want to get in, they're usually around $2,500, but if you're in an IRA or a Roth IRA, the minimums might be even lower than that. You'll have to check, and that'll be determined by what company you're doing this with. They're traded only once per day, and the price that you receive is called the net asset value, and that's calculated after the stock market closes. Now, how could that be an advantage? Well, sometimes we can really be going down strong where somebody who's in the market and has to make a decision while the market is open. And so they panic and they decide to sell what they have, only to have things rebound and end up closing not as bad as they were. So there's a real advantage sometimes to being at a point where you just say, I can't do anything about this. I could put my order in now, but it's not going to be executed until after the close. So there are times when that can really be an advantage. There are also times when that is a disadvantage. If things are just crashing all around and there's nothing you can do about it, you just have to sit and wait until there is a time when you can do something about it. And then as far as pricing of mutual funds, prices fluctuate throughout the day. As far as pricing, this kind of gets into what I was just talking about. Prices fluctuate all the time. There's an open, a high, a low, and a close, not only for each stock, but for each index. And all these price fluctuations, you don't really have to worry about that. You are basing things on the close. The net asset value is calculated on closing prices. Now, there are exceptions to that. There are some mutual funds that give you a morning cutoff time and an afternoon cutoff time. But for most of you that deal with general mutual funds, that won't be the case. If you enter your order today, it won't be executed until the close of the following trading day. So let's look at the net asset value, or NAV. Mutual fund values are calculated differently than stock values. A stock price can change multiple times even within a minute. Some of the real active stocks, Microsoft, Apple, Google, they're flying around all over the place, and their prices can change all the time. When the market closes for that day, the last price of a stock is known as the closing price. Since mutual funds are a basket of securities, their values are reported as a net asset value. They take the closing prices of all the stocks in that mutual fund, they calculate them all together, they take out the expenses for the mutual fund, and then they post an NAV. And a lot of times you can get a text message sent to you or an email. You can go to their website to find this out. Financial publications will quite often have NAVs posted. The NAV is then calculated shortly after the market closes and then published by the mutual fund company. Current NAVs can be found online or in financial publications, as I just talked about. So this information is pretty easy to get. In fact, if you're in a mutual fund and you know the symbol, all you have to do is go to Google, type in that symbol, and boom, it will show up right there with a chart, and it'll tell you the current NAV. What are some of the disadvantages of mutual funds? As with most things in life, there are trade-offs. There's some good and some bad. Pay me now, pay me later. Positive and negative. Mutual funds must make money by charging fees. They have to do that. If you want a good money manager, they're going to have to pay that manager a good salary. And who pays for that manager? You do. Mutual fund investing involves paying fees. Some of these fees are known as 12B1 fees. And there are whole sites that list all of this like a spreadsheet. You can compare the expense ratios and all the different fees of one mutual fund to the other. And some people are really into that. Other people just say, no, I want to invest in a good quality mutual fund. I know I'm going to pay a little bit extra to have this managed on my behalf, and I'm not worried about that as much. There are websites and services that allow investors to compare fees, and the one that's probably the most well known is Morningstar.com. These are fees that are paid in order to have money managed on your behalf. A mutual fund may have an excellent year or even have a lot of good years in a row. However, this is no guarantee that in the future, that mutual fund will still do good or even the same or even have a positive year. And this has been one of the drawbacks to mutual funds. People like to chase mutual funds that have already done a good job, and then they're disappointed when that mutual fund doesn't continue having good, solid returns. What are some more disadvantages of mutual funds? There have been, through the course of time, some management abuses. They can do a thing called churning, which is where they're trying to get in and out of stocks. They're buying and selling a lot, and they do a lot of over trading. Mutual fund managers are human beings, and they chase returns just like individual investors do. And sometimes they get to the party late. And about the time they get into something is about when the party is over. One of the disadvantages, too, of a mutual fund is they don't invest just $1,000 or $2,000. They're quite often investing millions of dollars, and so they can't just get in and get out quickly. When they get into an investment, they have to get into it over a period of time, and when they decide to unload an investment, they get out incrementally as well. There's also a lot of turnover, which is where they replace stocks often, where they're chasing winners after they have already won. There's a thing called window dressing, where at the end of each quarter, they'll sell off the losers before the end of the quarter to make their returns look better. So there's a little bit of manipulation that can go on so that when you get your information about your mutual fund, it might look a little better than it really is. Also, there's a tax inefficiency. Turnovers, redemptions, gains, and losses during the year can be taxable events. I remember talking to a friend back during the financial crisis, and stocks were really going down. Their mutual funds were not doing well. They were losing money. And then to add insult to injury, they ended up getting something in the mail where they owed tax on their mutual fund. Even though their mutual fund went down, the mutual fund manager had sold off some of the stocks, which created a taxable event, and that flows through to the investors, and they have to end up paying that as part of their taxes. And there can be poor trade execution. Trades must be made before the cutoff time to get the same day NAV. With mutual funds, there is a cutoff time where if you decide you're going to get in or get out, you have to place your order by a specific time, or it won't be calculated after the close of that day. And if you get busy or you forget or you get distracted, that could be a real disadvantage for you. So what do people do? They might place their order over the weekend. Well, please understand that if you put in your order on a Saturday morning, it's not going to be executed until after the close on Monday. A lot of things could have happened during that time, and you may change your mind. But you may not be at a place where you can contact your mutual fund company and let them know to cancel that order. But also know at the same time that can work to your advantage. You place your order, you forget about it, and it's like, oh, I didn't realize that happened. And it actually worked to your benefit. And then there is slower timing. Quicker executions are not possible. Also, strong gains may be chased and missed. That's when we're chasing a mutual fund. This is what I've seen through a lot of students through the years, especially in the S&P 500 mutual funds. We have a really strong day, and so somebody who was not in a mutual fund, they decide to get in. Well, right as that happens, that might have been the high for that particular day, and so prices are starting to fall back. So instead of being a part of the big advance, they're now seeing a loss, even though it was an up day overall. So it takes some real discipline to be able to do this. It is possible, and it's what I teach people how to do, but you have to make this a priority if you're going to use this approach to using mutual funds. Another thing that we have to be aware of are market conditions. We can take advantage of market conditions if the markets are going up, but this can also be a disadvantage if the markets are going down. An advantage can be it avoids using emotions. As I talked about earlier, you're only concerned with the NAV. You're looking at the close of the market. If you're in an S&P 500 fund, we may have started out being down 5% only to come back and finish about at break even. Well, there's a lot of people that went through a lot of emotions while that was happening. That doesn't apply to you because you're focused on the closing price, and prices closed at pretty much the same place today that they closed yesterday. So you didn't have to go through that whole roller coaster of emotions that a lot of other people did. The disadvantage to that is you stay in when getting out would have been best. So sometimes this can work to your advantage, and sometimes this may work to your disadvantage. Since the prospectus dictates what a mutual fund can do, the manager is bound to do what it says it will do. It can't go outside of the parameters, but if it says we are long stocks and we will only have 5 to 10% of our money in cash, the mutual fund manager has to invest even if the markets are going in the toilet. So we might be going down, down, down. The mutual fund manager is obligated to keep 90% invested at all times. If the market's going up or down, a manager must trade according to the prospectus. This can be really to your advantage when they're right. It can be to your disadvantage when things are going down. So here's a debate. Actively managed mutual funds, are they better, or are passive mutual funds better? Let me explain what those are and then what might be better. Opinions can run very high in this category. Some people think, no, I want some hot shot money manager and I'm willing to pay extra for that. And this manager is out looking for the next latest and greatest investments. They have a pretty good track record. They're actively involved in what they're doing. Well, with a passive mutual fund, there's really nothing that needs to be done. The passive mutual fund is tied to an index. So if the index goes up, the mutual fund goes up, and vice versa. Active fund managers try to beat the market, but research has shown that most money managers over the long term don't beat the market. So a lot of people would have been better off just putting their money into an S&P 500 mutual fund and just going with that. There would have been years when they would have lagged behind other actively managed funds, but over the long term, they would have outperformed other mutual funds that are actively managed. Passive investments have more investment flows and greater consistent historical returns. That's based on some of the research that I ran across. A lot of people are saying, yeah, the S&P 500 is doing pretty well. So more flows are going in to those mutual funds. And over the long term, the S&P 500 has averaged about 9 to 10%. And so people like that. They know that there are times when the hotshot mutual funds may outperform them, but they're looking at a bigger picture. And so they decide they want to be in an index fund instead. Active investing tends to become more popular with market declines. And if you think about it, that makes sense. If you have a manager that is really actively involved in what's happening, they see storm clouds starting to develop, they see prices start to go down, and so they can rearrange things. Where stocks that are inside of an index, they're just going to go up and down no matter what's happening. So what are some of the advantages and disadvantages? Passive investing advantages is there are lower fees because you don't have to have a hotshot money manager. If you're basing it on the S&P 500, anytime the S&P 500 adds or takes away a stock, your decision has been made for you. You don't have to do a lot of research to figure that out. There's a lot of transparency. If you know what the S&P 500 is, you know what stocks you are investing in. You can go to Standard & Poor's website or a multitude of websites to find out what stocks make up the S&P 500. They're more tax efficient since there are usually fewer capital gains. Stocks that are part of an index tend to stay part of an index for a long period of time. Where an active fund, they might be buying and selling left and right, and that could produce a lot more taxable events. Some of the disadvantages to investing in an index fund or doing passive investing, there are limitations. Even though there are a lot of indexes out there, you're limited in the choices that you have, and you're also limited to the stocks that make up that index. Sometimes they give lower returns than what you desire, especially if you're getting together with a friend or at a party and somebody says, yeah, my mutual fund had a 35% return last year. And you're looking at your S&P 500 fund and you go, okay, I was up 8%. There's a little bit of fear and greed going on there. There might be some jealousy. There might be, oh, I've been left behind, and you may be more inclined to desire to make a change. What are some of the advantages of active investing? There is a greater flexibility. Since you have a money manager who's out there looking for good investments on your behalf, they can be more flexible with how they invest money. They can also practice hedging. Now, this is not a hedge fund. Hedge funds and hedging are completely different things. But some managers, what they can do is if one part of their portfolio goes down, they can set it up so that another part of the portfolio goes up. Or they might implement flat out hedging, where you use options or futures contracts to hedge against losses. There's also better tax management. Now, you may end up paying the tax bill, but you don't have to keep track of all the buying and selling that goes on. You're just given a report, especially at the end of the year, with a number on it that says this is how much tax you have to pay. And some managers, they're really in the know with the different tax laws and different ways that they can buy and sell and get into investments where maybe you don't have taxes that you have to pay. What are some of the disadvantages of active investing? There are higher fees. You're going to pay more to get a manager to invest on your behalf. There can also be greater risk. If a manager is out there looking for good returns, it's not always going to work out. And so they may put the mutual fund that you're in at greater risk. So lately, there's been a real change in the alternatives that are available to us. Up until the late 1990s, mutual funds were probably the best alternative for individual investors. And you're probably involved in mutual funds, and they're very good, and they will be around still into the future. But we've seen the development and popularity of another vehicle that you might want to consider as an alternative. This new trading vehicle was developed that many believe may lead to the demise of mutual funds. I don't necessarily believe that. I think mutual funds will always have a place, but they're not as popular as they used to be because of this alternative investment vehicle. This is covered in the next video where I talk about exchange traded funds, or ETFs, and they're all the rage right now. So thank you. This ends Module 2, Section 4, and I will pick up again in Module 2, Section 5.